Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the U.S. stock rally cooling with equities sliding for a third day. We'll have full market coverage. Plus, CoreWeave is expanding its deal with OpenAI to as much as a total of $22.4 billion. How long can OpenAI's massive spend last? And we'll get a read on the state of the consumer as second quarter GDP grew at its fastest clip in 2 years. Let's take a look at the markets right now because we are seeing this sell-off continue. The Dow down about 185 points today, about 0.4%. The S&P 500 down 0.8%, and the Nasdaq Composite down 1.2%. Now, in particular, I want to look at the three-day sell-off that we've seen in the Nasdaq because this has really been a large-cap tech-led sell-off that we've seen. So it's down 2.5% over the past 3 days as we've had some concerns resurface about the spending cycle for artificial intelligence and how long it can kind of be sustained or sustain itself, I guess, more appropriately. Some of the other things I'm watching this morning after we got that better than expected revision to second quarter GDP, yes, backward looking, but it was accompanied by initial jobless claims coming in at their lowest level since July. So we see an uptick in yields, not a huge one. This chart makes it look a little bit larger than it has been, but seeing a little bit of an uptick in yields to 4.18%. We see the dollar with a bit of an uptick showing the three-day charts here, so you get a little bit more perspective on all of this. And Bitcoin, just checking on that because we continue to see some selling going on in cryptocurrencies. Now, getting back to large cap technology, taking a look at the NASDAQ 100 here and the weakness that we were seeing, a lot of red on the screen, far outweighing the green, although you have Apple just peeking into the green here. These are not deep losses, right? But we are seeing red and some wavering of this trade that has really dominated this year in terms of the AI trade. If you look at the sectors as well, you see it play out. Consumer discretionary, which includes some of those tech names, and the XLK, which is the tech index, also falling in today's session. Moving on and talking about the backdrop for all of this, let's get more on that burst of positive economic news out this morning. Revised inflation-adjusted GDP for the second quarter came in at a healthy 3.8%. That was stronger than the 3.3% figure that was previously reported. And meanwhile, in a sign of strength for the labor market, initial jobless claims edged lower to 218,000, and July existing home sales, which just crossed, ticked higher to just over 4 million. So how does the U.S. economy keep chugging along amid what seems like a drumbeat of dire predictions? Joining me now, Jeremy Siegel, Wharton Professor Emeritus of Finance. Jeremy, it's great to see you. It's been a while, so it's good to catch up.
Yes. Good to see you, Julie.
You know, I am so interested in the trajectory of the economy this year because once again, we had a year in which economists were feeling pretty pessimistic, right? Even before we got those tariff headlines, the worst of the tariff headlines in April, there was a lot of pessimism out there. And seemingly, the economy has held up a lot better. What's been behind that?
Yeah, well, I really think the tariff really is what shook everyone. The so-called Liberation Day really started, the terrible sell-off in the market and consumer sentiment. But things have been much better than people had expected, and for a number of reasons. One is the tariffs are nowhere near as bad as what Trump put out in April. So there's been a lot of deals, a lot of negotiations, a lot of exemptions. I don't like these tariffs. I don't think this is the way to do them, but they have not been as bad as originally feared. Secondly, we do have an AI boom. And we do have the promise that whatever extra costs corporations might experience because of the tariffs, they might be able to obviate because of the implementation of AI. In other words, the improvement of productivity that AI promises can offset some of those extra costs of the tariffs. On top of that, we did get a new tax bill that is very, very generous to expensing capital equipment. This has done a good job for corporate profits. And secondly, the fall of the dollar, which might eventually hurt the consumer in terms of higher prices, is certainly good for our exporters. So there have been the positive impacts that have offset that negative tariff hit.
Is it Strange to see in view of in view of all of this strong economic data, a Fed cutting into that environment, especially you see this revision to GDP for last quarter. Do you worry at all about an overheating economy and a Fed cutting into that?
Yeah, I mean, I see that as a concern, but I don't think that inflation is really going to be a concern. Of course, Friday we get the PCE deflator. I expect that to come very much in line. In fact, there's even a possibility of one tick being a little bit lower than expected. I also monitor credit expansion, the money supply. It has been very tame. This is not something like what we experienced in 2021, 2022, off to the races. Commodity prices have been well contained. Oil, it has its ups and downs, but it has been, very level in the prices. Home prices are beginning to go down moderately. Rental prices are now finally going down moderately. So I don't see that we're on the verge of an inflationary trend. Now, the tariffs are going to affect quite a number of inputs, but again, I think the Fed needs to look beyond the tariffs. That's a tax increase, a one-time increase. It is not really driven by forces of increased demand in the economy. So actually, I support the continuing move of decline of interest rates by the Federal Reserve. I actually think that the Fed funds rate should drop into the mid to low 3% by next year, which would be 3 or 4 more cuts. So I don't think inflation is a problem, and I think that the slowdown in the labor market growth, which has a lot to do, of course, with the immigration policies of the Trump administration, that slowdown does actually call for some reduction in interest rates.
Gotcha. Okay. And I also want to ask about housing a little bit more, which you alluded to. We just got data for sales of existing homes or previously owned homes. They fell a little bit, down 0.2% in August, the annualized pace at 4 million. It seems like the high cost of a home is still a bit of a stumbling block for people. It was up 2%, median home sales price up 2%, $422,600. What's your view of those dynamics within the housing market right now?
Well, from 2020, when the pandemic began, to 2022, that 2-year period brought the biggest 2-year rise in home prices that we've ever experienced. I mean, that was a 45%. And then they continue to trend upward, not anywhere near as fast. Only in the last 6 months beginning to look like they've topped out. But yes, I mean, that's a source of a lot of dissatisfaction. I mean, it's the have and have-nots, really. I mean, 2/3 of Americans do own their own home. They're fine. Their home equity has gone up. But those that have been renters not only have seen their rent increase, but seen the dream of home ownership, which is, one of the American dreams, it looks farther and farther away. The only good news on this is we really are beginning to see a drop in those mortgage rates and a softening of home prices. It's not going to be something that suddenly makes everything affordable, but it is going to help a little bit going forward for those that need would like to buy their own home.
So, Jeremy, we've been talking all about the sort of economic backdrop, whether it's housing or some of the other elements that we've been talking about. I'm curious to get your view on stocks right now, though. We've seen, obviously, there's a little pause the last few days, but we've seen this big push higher day after day after day. Does that continue in your view? I mean, it sounds like you think the backdrop is pretty good.
I think the backdrop is good. I think we've got some more juice in this rally. It's hard to say, when, how much more. I certainly think we're closer to the top of the big increase we've had since the April lows, but I would not be surprised to see another 5 to 10% on this stock market before we level off and could have a reaction. Of course, as everyone knows, trying to predict the stock market in the short run is sort of a fool's errand. I guess I'm one of the very few academics willing to stick out his neck and and do that. I'm going to certainly be wrong a number of times, but I think I have my pulse on some of the basic market trends. I think they're still up. The end of August and September are notably very difficult months, and we're just getting, the end of September now, so we're seeing that little softening. October is usually only a bad month if September is a bad month. So a lot of people talk about crashes in October, but the truth of the matter is that crashes in October are usually preceded by dramatic declines in September. And clearly we wouldn't have not had that.
Right. Yes, so maybe it bodes well. And Jeremy, the fact that you have an opinion is one of the reasons that we like to talk to you. So thanks so much for joining us here today. Take care.
I will. Thank you, Julie.
Thanks. OpenAI is inking multi-billion-dollar deals, while my next guest is concerned about the company's, quote, overextended commitment. Stay tuned. You're watching Market Catalysts. Coreweave is expanding its agreement with OpenAI by up to $6.5 billion. This is, of course, just the latest deal for OpenAI, following partnership agreements with NVIDIA and Oracle this month. Joining me now, Gil Luria, D.A. Davidson, Head of Technology Research. Gil, it's good to see you. Obviously, OpenAI has been spending a lot of money in order to get this compute capacity to keep powering its training, its inference, and there are a lot of questions about its ability to keep spending. So I'm curious how you're thinking about it and what it means for this whole ecosystem.
Yeah, so this is one of the most impressive cases of fake it till you make it from Silicon Valley. That's a well-worn tradition in Silicon Valley to make big promises and hope that you can fulfill them. And that's what OpenAI is doing here. Again, as a baseline, a company that's going to have $12 billion of revenue this year, lose tens of billions of dollars, and is making commitments that they, by their count, are now $500 billion, $500 billion. The likelihood that they'll be able to live up to those commitments is quite low, which is to say it's not zero. ChatGPT does have a head start. It's very popular. It's very useful. But they're betting that they can make all these compute commitments, secure that compute, and that will somehow crowd their competitors. Not sure that necessarily can be the case, since their competitors are Google and Meta and Anthropic, which is backed by Amazon, and Elon Musk's xAI, also very well-funded enterprises, while on the other hand, OpenAI now needs to go raise this $500 billion that they've promised, and that's not trivial. Again, they may be able to do it, but for now, it just looks like a fake it till you make it situation.
Well, given that all of these other companies are now pretty reliant on OpenAI for these big commitments, right? You look at an Oracle, you look at NVIDIA, which has also invested money in OpenAI. This latest expansion of the agreement with CoreWeave, which I know you don't cover, but what does that mean then for that whole group of companies?
Yeah, so we have to separate in AI right now. The real companies that will do well under a wide range of scenarios, these are the big hyperscalers: Microsoft, Amazon, Google, NVIDIA, which one way or another is going to supply the chips. It doesn't matter who they're selling to. And then there's marginal players. And in fact, those are players that are entirely relying on OpenAI. That's CoreWeave and Oracle, who are entirely relying on OpenAI. It doesn't matter how many more commitments CoreWeave and Oracle get from OpenAI. It's the same funny money that may or may not materialize. And that's where we're at. So we have to separate the real companies that are building out AI, and then the marginal companies that are just benefiting from the excitement and the expansion of the AI trade.
I want to ask about Oracle in particular, because Oracle seems like it's on top of the world right now, right? It's been, it looks like it's going to get part of this US slice of TikTok. It's been signing these new deals. There's the whole Stargate situation. But it sounds like you have some reservations about all of that.
Yeah, so again, let's separate what's real, valuable, and what's a little bit of a speculation. Oracle getting the TikTok business is a windfall. The fact that Larry Ellison or Oracle are going to own a piece of TikTok, that TikTok USA will continue to be managed by Oracle, possibly in an expanded role, that is a nice windfall for Oracle. We don't know exactly how much, but it should help the real business grow. Everything else is an OpenAI commitment. Oracle had $80 billion of backlog remaining performance obligations a year ago, and now they're reporting 455. That's what got everybody excited. Only when you start peeling the onion, you see that almost the entire increase is OpenAI obligations, and the vast majority of those are in out years, 2027 to 2030. So that isn't real. It might become real, but it shouldn't be creating this much market value. Just to run you through the numbers, Oracle has added $400 billion of market value based on a $300 billion deal that at best they'll get $30 billion of profit from a few years down the road. So it's completely disproportionate. By the way, from a company, again, that has 12 billion of revenue and itself is only worth 300 billion. It doesn't make sense. It doesn't add up. There's way too much excitement that we had from Oracle because when they came out and announced it, they announced it as if it was several large customers. It's the next day that we found out that it's almost entirely OpenAI.
This is so interesting. One other thing I wanted to ask you about Oracle, since I haven't gotten your take since it happened, is Safra Catz transitioning into that vice chair role and to be replaced by two co-CEOs. So it seems like part of what you're talking about, yes, is this reliance on AI, but there also is an execution piece. It has to, if the business does indeed come its way, if the spending happens, it has to take advantage and fulfill this backlog. Are those the right leaders, the replacements for Katz? Are those the right people to do it?
Yeah, and to be fair, Safra Catz has done an unbelievable job. Yeah. Oracle was a very stagnant old tech company when she took over, and she's been able to bring it to today where, I want to be clear, Oracle Cloud is a great business that Oracle has created from scratch, and it's now legitimately the fourth largest hyperscaler. So Safra's done an amazing job. The two folks that are going to replace her are internal promotes. They've helped along the way. There's no issue of execution here. It's just a matter of how much credit you give Oracle for one promise from one company that's in no position to make those promises.
Gil, finally, I want to ask you about kind of taking a little bit of a left turn, another headline that caught our eye. And this is the report from Bloomberg that Intel had tried to solicit Apple to also invest in it, as we have seen other companies and the US government, for that matter, doing. Does that kind of partnership make sense to you from the Apple perspective? It sounds like it's still in early stages and might not happen.
No, it very much does make sense. Let's rewind a month ago. Intel was saying that they would love to go into their new 14A technology and build that out in the United States. They just don't have any customers, which was very alarming at the time. That meant they really didn't have a viable way forward as a company. The United States government stepped in and said, no, we need there to be a domestic manufacturer of semis, and we will do that by backing Intel up, by taking a stake in it, and by getting involved. Lo and behold, a week later, NVIDIA signed up as an investor and to be a 14A customer likely down the road. And now what Intel needs is for Apple, the other biggest consumer of semiconductors, to sign up to have a domestic manufacturer of chips. This is of strategic importance to the US, and for Intel to be successful, it needs these anchor tenants. There couldn't be two better anchor tenants. They've already signed up NVIDIA. Now they need to sign up Apple.
All right, we'll see how it ends up working out, because the NVIDIA agreement doesn't yet include Intel actually making those chips, right? It's just them designing the chips together. But we'll see how it goes. We got to leave it there. Gil, thank you so much. Appreciate it.
Thank you.
A new RV startup called Lightship, co-founded by a former Tesla battery engineer, makes trailers that power themselves on the road and run on battery and solar at the campsite. Yahoo Finance's Josh Lipton spoke to Lightship co-founder and chief product officer Ben Parker.
So maybe start big picture, Ben, just for the the uninitiated who are listening right now, explain a little bit about Lightship, the problem you all are solving for. What makes you sort of different than the competition? What separates you?
Yeah, I mean, well, Josh, nice.
Good to meet you,
nice
man.
To see you. Thanks for having us. I would say the RV is it's an American icon. It's a pastime that so many Americans love. 10% of the country, believe it or not, own an RV. So this is huge. Huge part of Americana, and yet RVs in a lot of ways have not changed in 20, 30, maybe 40 years. And so my co-founder thought, he was also Tesla, that it was time for a big refresh of the RV. The world has changed a lot over the past 20 or 30 years, and we thought it was time to bring RVs up to date and into this new age of digitization, electrification, and still keep the most beautiful parts of camping the same that they've always been. I think in some ways camping is even better in such an action-packed world today than in decades past.
I totally agree with you. We think RV is as Americana as it gets. I mean, it's like baseball games, barbecue, and RVs, right? How fast, though, Ben? I'm just curious. How fast is that market growing?
Well, I think the numbers would tell you it's 5 to 7% a year and has been for a long time. Maybe more of the story behind it is that RVing has just been it's been a big part of the American experience for a long time, but it's been steadily on this uptick. More and more people are sort of wanting to get back to nature and have great natural experiences. We were talking about COVID off air. It really accelerated during COVID. So many people in our generation, millennial generation, got to experience RVing for the first time and were converted by it. And the Great American Road Trip is alive and well. It's just it's getting better, and we're trying to hasten that.
What are the benefits, Ben, if you explain like an electric RV as opposed to your traditional gas guzzler? Is it because it's cleaner, it's quieter? Like, what are the advantages?
Well, one thing to explain up front is that what we build at Lightship is a towable RV. So their RVs are towable and drivable. Drivable, you got the steering wheel, usually called a motorhome as well. Towables are the RVs that you hitch behind your truck and pull. About 90% of RVs sold in the US are towable because Americans love big trucks and SUVs, and so once you've got that that love affair, the towable follows. What sets us apart in the type of towable that we build is that we took our background from places like Tesla, where my co-founder and I found our start. He led the finance team there. I was a battery engineer there. Other new automotive startups that have since grown big, places like Rivian, Lucid, and applied what we had learned there to this new space. So we took a ground up approach. We thought about if you're starting from scratch, what should a towable RV behave like? And what came out, if people go to our website, lightshiprv.com, is basically a road-going spaceship. This thing looks, it's not your grandfather's RV, although we do have a lot of grandpas who are excited about it. It looks totally unique. It's got this really streamlined aerodynamic shape when you're towing it, which we call the road mode. And then the whole body of the vehicle expands to be double the size when you get to the campground. So you get this really awesome, spacious living space with panoramic wraparound windows. If you're in a beautiful place like a national park, you catch the full vista. Maybe Half Dome is right in front of you in Yosemite. The entire roof of the RV is covered in solar. So we integrate solar panels right into the shape of the Lightship. And then in the floor, we pack a giant EV battery. It's a battery that is the same size as you would find in something like a Tesla Model 3 or a Model Y. So really big, 50 to 100 times as big as what you'd find in a traditional RV. And we can use that solar plus the battery to power all of your appliances on board. So if you're off grid, you can just keep camping for days and not worry about running out of power. We even use that same EV battery to power a motor on the trailer. So this is something that makes a Lightship a totally new class of vehicle. It is a self-propelling trailer. It acts a little bit like an e-bike in the sense that the motor on the trailer assists the truck that's pulling it. So the truck doesn't feel the weight of the Lightship as it's pulling it down the road, which is pretty impressive because it's a 27-foot long, close to 8,000 pound vehicle when it's fully loaded. And that truck, if it's a gas or a diesel truck, will keep its normal highway fuel economy and get great kind of hybrid performance.
Let me ask you, Ben, how much does this all cost?
It's I would say we are starting in a premium segment of the market. It's not priced to infinity. We are a
What does
company
premium mean, Ben?
Premium means $100,000 to $200,000.
Okay.
We start at $125,000, and you can option up a Lightship into the high hundreds. So you would compare it. If you're thinking about products that are out there today, it's something like an Airstream. It's a really nice trailer. Now, of course, our ambition is to grow big and make Lightship a household brand name.
Does that mean more? Would that necessarily mean, Ben, relatively smaller, more affordable models on the way?
Yes. This is the beginning.
Yeah.
People RV in a lot of different ways, and there need to be different access points to getting into a Lightship, and so we're thinking about all the ways that we can offer people that experience, including a lineup of products.
Ben, I got to tell you, that VO makes me want to RV.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're taking a closer look at Wendy's, CarMax, and Uranium Energy. Wendy's seeing some downward pressure after an analyst from North Coast downgraded the fast food chain to sell from neutral. He said it needs new leadership and marketing strategies. Now, since mid-July, Wendy's CFO, Ken Cook, has been serving as the interim CEO. The analyst went on to say that it continues to see pressure in its breakfast day part, lack of marketing strategy, and if with no improvement in same-store sales growth next year, U.S. stores could be at risk of being closed. Next up, we have CarMax. That stock is tanking today. It's down more than 23%. The auto retailer posted second quarter results that missed Wall Street's expectations across the board. And now that analysts over at Wedbush, well, they downgraded the stock to neutral from outperform. The analyst there said that the results may have amplified investor concerns around its ability to maintain market leadership and drive growth. And last up, we're taking a closer look at Uranium Energy under pressure after BMO downgraded the stock to market perform. The stock has had quite the run, though, since early June. It's up about 140%. And the analyst there said the stock is now fairly priced versus its peers, but does have a number of near-term catalysts, including potentially positive U.S. policy developments. And that's today's top calls. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching SAP, Jabil, and Birkenstock. First up, SAP. The European Commission launched an antitrust probe into the German software giant, citing concerns about the company's practices in software support services. The EU probe relates to a piece of SAP software called Enterprise Resource Planning, or ERP. ERP widely used by large corporations to manage their everyday finance and accounting needs. In a statement, SAP said it believed its policies and actions were fully compliant with EU competition rules. Next up, Jabil, the Apple supplier, out with quarterly earnings that topped expectations, but the stock is under pressure. A potential why behind the drop? A margin miss in its AI segment. Vital Knowledge analysts say the results showed pressure in its intelligent infrastructure segment, and while the headline numbers looked strong, that was a net negative in the release, those shares down 6.5%. And Birkenstock as well, the company raising its sales forecast slightly higher amid strong demand for its sandals and clogs. Birkenstock also announced plans for a new factory to boost production. That stock also under pressure, though, and was down about 20% this year. The footwear world has struggled with rising tariffs and supply chain snags. Birkenstock, which makes almost all of its products in Germany, has begun to compensate for those challenges by raising prices. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we'll dive into the health of the consumer and how inflation could affect spending this holiday season. That's next on Market Catalysts. Strong consumer spending continues to prop up economic growth. Personal consumption was revised higher for the second quarter, rising 2.5% according to the Bureau of Economic Analysis. Economists are expecting some pullback in spending in the fourth quarter as the labor market weakens. Let's talk more about this with Michelle Meyer, MasterCard Economics Institute Chief Economist. Great to see you.
Yeah, thank you. Great to be here.
So it was interesting to see that second quarter, third reading this morning. The consumer spending, as I mentioned, 2.5%. The overall reading, 3.8%. And I'm just struck by that these economic numbers just keep holding up and holding up and holding up. What's your impression?
They do. I mean, I think it makes sense in the regard that, yes, job creation has slowed, but aggregate wages remain strong in the sense that average hourly earnings have held up, and we are still net adding jobs, which is supporting overall income growth and therefore supporting consumer spending. So, throughout the cycle, the consumer has been an extraordinary force of growth and expansion and has proven again and again to be resilient.
And will continue to be resilient, it sounds like, judging from your holiday forecast at the MasterCard Enterprise Economics Institute, 3.6% is what you're looking for holiday spending?
That's right. So based off of what we're seeing from our spending poll status, so the regular data that's coming in day to day, the trend is coming in strong to start the season. So we're taking a lot of notice from that. And when we measure our holiday sales and forecast it forward from November 1st to December 24th, we're looking for 3.6% growth year over year in retail ex autos. And I mean, that's partly a function of relatively higher prices for certain categories of spend. But again, also just this trend that we've been seeing in terms of the consumer engaging.
Give me a little historical perspective on that. So 3.6%, how does that compare to recent years?
So it's a bit of a moderation from last year, which was very strong. So last year we calculated 4.1% for holiday spend. And then if you compare going back more than that, you have the COVID distortions, like tons of weird stuff in the data. So I would say 3.6% on a trend basis is slightly above trend.
And you mentioned the higher prices. Where are you seeing that start to, because we keep saying it's coming, it's coming, it's coming. Where, where are we starting to see it?
So I think it's all very slow and it's marginal. That's the key point. Relative to, I think, some expectations or fears that, tariffs will be implemented, we turn around the next day, we're going to see that same magnitude of increase on the shelves when people check out, and that certainly has not transpired. But if you look at the monthly CPI data, certainly there's a handful of categories where prices are starting to accelerate slowly, but still head higher, which is an inflection from this time last year where a lot of those goods categories were disinflating or even deflating. So that is one of the big differences in the holiday season as we think about last year versus this year. Last year, we entered a holiday season with very low or falling prices. This year, we're entering a holiday season with slightly higher price inflation for certain categories.
Is the risk that those prices almost kind of peak into the holidays because of the way the retail ordering cycle has played out?
So the retail ordering cycle matters a lot in the sense of how much inventory they have available for the holiday season. And I do think a lot of particularly the larger retailers have been quite savvy in seeing this big stockpiling that happened at the beginning of the year. And then before the latest round of tariffs hit in, it looked like from the trade data there was another round of imports and therefore inventory build. So inventory levels on aggregate seem pretty okay at the moment, but we'll see. If consumers spend early and they spend more aggressively, what does that mean for inventory as we enter the end of the year, especially in a world where it's become more expensive to continue to bring product from overseas.
If they're catching up and doing ordering. And speaking of whether people are going to shop early, you flagged in your report a calendar quirk this year that it's a late Thanksgiving. So why does that matter?
Well, it was really late last year as well. This is one day less late, but still it constrains the period between Black Friday and Christmas. So it does mean for retailers and for consumers to, again, just be that much more savvy to make sure that they're getting what they need when it comes to the holiday period, that they're finding those moments where they can optimize value through these heavy promotion periods. So last Black Friday was quite robust, I think in part because it was a little bit later and you had this big, rush to find those promotions and to receive those promotions.
Something else I wanted to ask you about that got a lot of attention recently, an analysis from Moody's that showed that the top 10% of income is doing about half the spending in this country, which is the highest we've seen it. What are the implications for, like, how long can that keep up? Does it matter from an economic perspective if that's the case?
Well, it matters in terms of the sustainability of spend, right? The broader the spend is, the better, of course, it is for the long run if more people have purchasing power and can contribute and participate in the economy. And for the moment, I think it depends on a variety of factors in terms of spending. On the one hand, the very powerful wealth effect is certainly going to benefit those that have access to that wealth. So when you think about how much financial assets have appreciated or how much housing has appreciated, it's the folks that are sitting on those assets that are going to see those wealth gains and therefore that spending power. But the labor market also matters tremendously as well when we're thinking about where the spending is coming from. So which sectors are seeing the job creation? Across what income levels are we seeing the job creation? And there's been some shifts there as well, but not necessarily just based off of income, it's more based off of skill set.
Oh, interesting. So if you have any concerns, where would what are you looking for to see if things are going to deteriorate at all?
So I think following the labor market is really important. And we certainly have seen this moderation in job creation, but we have not seen an increase in the unemployment rate, and we haven't seen, on aggregate, much change in wages either. Wage growth is still running above underlying price inflation. So following not just the monthly jobs numbers, but measures of overall churn and movement in the labor market are going to be important. Whether or not there's forced detachment, if firing picks up, that's obviously a big challenge and red flag. So the jobless claims numbers are important. They've remained at very low levels.
Right.
And then for us in particular at the Economics Institute, following our own spending data to see if there's any discrete shifts. And so far it really does look like this is a consumer that is spending.
One of the trends we've been talking a lot about is the difficulty for new grads in this job market.
Yeah.
And I think in part AI is probably a part of that. Companies maybe not hiring as many people. Maybe that's not a spending problem today, but is that a spending problem next year or the year after that or for the foreseeable future?
Yeah, but I mean, it's about the structure of the economy.
Right.
When you think about GDP or output, it's your labor and how productive your labor is, which is comes from capital investment. And certainly there's been a lot of investment in capital, particularly when it comes to AI and the new technologies surrounding that. So the question is that how does that potentially weigh what it means for the workforce? And there's going to be a lot of shifts. I think it's a little bit too early to say that there's a real displacement. I think it's getting a lot of headlines in the sense of looking at unemployment rates for certain sectors, certain age groups. But we'll see, and we do have to pay a lot of attention to that as well.
We'll be data dependent like
Yes.
the Fed
Yeah.
on that one.
Always.
Michelle, great to see you. Thanks so much for coming in. Coming up, we're going to speak to the CEO of cybersecurity firm Rubrik about competition in the industry, AI, and more. That's next on Market Catalysts. We're checking in on cybersecurity firm Rubrik. Those shares have been under pressure, down nearly 11% in the past month as investors become wary of the stock's valuation and the demand landscape. Still, stocks have just about doubled since its IPO last year. Joining me now is Bipul Sinha, Rubrik CEO and Yahoo Finance executive editor Brian Sazi is here with me as well. Thanks for being here.
Thanks you so much for the opportunity.
So, as I mentioned, we have seen the stock take a little bit of a hit since last month, and there were some concerns, I guess, about the growth trajectory and the pace of growth. Can you talk to me a little bit about what you're seeing here in this latter part of the year and what you expect going into next year?
We had an excellent quarter. We grew our ARR by 36% at 1.25 billion total ARR. Our top line grew more than 50%, and we generated 57 million in free cash flow, which is 19% cash flow margin. So if you look at the top line growth of more than 50% and free cash flow margin of 19%, we are in this rare air. Look, I will leave the stock market reaction to the experts. but we are growing strongly in a very large market. I mean, cyber resiliency is the top priority for cybersecurity.
As someone that has spent a long time in the tech industry, are you surprised we're hearing about people concerned about peaking AI investment? Like, it just seems, I mean, I just came back from California for that Goldman Sachs tech conference. Everywhere I go, there's AI signs on the road, all over the place.
I mean, we are living in a world where $100 billion is like nothing. It's like everyday news. But that is the scale of the AI opportunity. If you just look at, for the first time, technology will actually replace human labor, or has the potential to replace human labor. And that actually changes the game. It changes the game for operations. It changes the game for cyber. Now somebody could take over your whole business processes and can do 10x damage in 1/10 of the second. So it's 100x more risk with AI, but 100x more opportunities. And that's where all the excitement comes from. But again, there is always overinvestment.
Yeah, well, and I don't know if it's that investment is peaking or if it's the money is real, right? That maybe is more the concern. But when it comes to cybersecurity in particular, because it is sort of an imperative, right? You have to protect your stuff. Do you feel like that it is more secure in terms of a business than some other parts of the AI landscape or the enterprise tech spending landscape?
Look, cybersecurity has changed in the last 15, 20 years. It used to be a bored teenager sitting in their parents' basement and trying to show middle finger to large organizations. Nowadays, it is like a threat actor sitting in Korea, sitting in North Korea and other countries, and they are trying to inflict damage like industrial espionage, cyber warfare, monetization of attacks such as ransomware. So it's a different ballgame. And as we are doing more digital transformation, AI transformation now with ChatGPT and everything else that has come up, the surface area is increasing. And so vulnerability continues to drive the demand for cyber. And I see robust demand for cyber for the foreseeable future.
How good are AI agents then? Yes, they may get things done, but what type of risks are they bringing inside of corporate America?
Funny you ask. We just announced Agent Rewind. People are concerned that agents are actually doing business work, business processes, such as doing a refund for some product that you have bought, or actually approving an expense on behalf of the CFO. And if these business processes hallucinate because the agents are probabilistic system or some external threat actor like controls these agents, then it can inflict tremendous damage and do tremendous damage to the organization. So everybody is asking for what is the remediation strategy. And that's why we launched Agent Rewind, to really undo the work of misbehaving agents.
So if AI and the expansion of the use of AI also increases the sort of surface threat area, if you will, is AI the best way to protect against that?
Absolutely, because volume variability and velocity of attack is only increasing. So we have to fight machine attack by machine. So us as defenders have to even accelerate our journey into AI so that we can use more advanced technology, more advanced AI to combat this incoming danger.
Since we talked, I believe at the time of your IPO, it feels like yesterday, but I've sensed not a shift, but you're really trying to expand your product offering. You recently made a pretty big acquisition. What does that do to your business, and how does it change the financial complexion of it?
Rubrik is the security and AI company. Obviously, cyber resilience and cybersecurity is where our core focus has been. But we see tremendous opportunity in AI operations and helping our customers confidently adopt agents. So we acquired a company called Predibase that actually creates accurate results from models by fine-tuning the model, as well as reduce the cost of inferencing. Plus, Agent Rewind undoes the action of misbehaving agents. So we are looking at this whole agentic operation holistically and saying, how do we give our customers the tools, the technology, the confidence so that they can do AI transformation and agentic transformation fast.
And how are you finding, especially as a public company, that you are differentiating Rubrik from other cybersecurity giants that are out there that are competing with you?
We have a completely different strategy. The cybersecurity giants are in the prevention and detection business, which has been a huge business. But our thesis is assume breach, assume that attacks will happen. And how do you continue to operate your business? And this is where we are building newer technology. This is where Rubrik Security Cloud and preemptive recovery engine has been the boon for our customers.
You have a phenomenal personal story, Bipul. You came over here to work in Atlanta, from India,
Yes.
right? So I think you offer a unique perspective on what we're hearing about H-1B visas. Zoom out first. What does this issue mean to you, and what's the wider impact to the tech industry?
Look, I came to America on H-1 visa, and I believe that America needs the best talent in the world. And so I leave the policy changes to the experts, but I believe that pathways for top talent from around the world has to come to America.
And are you all using H-1B visas also to bring talent to Rubrik?
It's not a significant part of our strategy because we have like operations in 19 countries and we actually hire local talent. Having said that, definitely we want like pathways for top talent from around the world.
Do you think you will be more likely to hire folks locally given that $100,000 fee? Will you keep the employees in those other countries rather than bringing them here to the US?
We always hire folks locally. I mean, we are a huge recruiter from all top universities in America. And we want to build the top company. I want to build a generational company. The opportunity that I got as an immigrant, I want to create this opportunity for everyone in America to reach to their highest career potential, and that's what we are focused on.
Thanks so much for coming in.
Good to see you.
Thank you.
And Brian Sazi, thank you so much.
Yeah, it's a pleasure to be here.
All right, coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, we go live to the NASDAQ to speak with the CEO of Kodiak after striking a $2.5 billion deal to go public. Plus, a small cap breakout will dig into the trade in today's Stocks in Translation. And we hone in on the rise of F1 racing in the U.S. and sit down with McLaren Racing's CEO. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here as we take a look at the major averages. They are under pressure to some degree, although not down as much as they were out of the gate this morning. The Dow right now down only about 8 points, 8 to 10 points. The S&P losing about 0.4%, as is the NASDAQ. Autonomous vehicle technology maker Kodiak Robotics has successfully combined with Ares Acquisition Corporation to form Kodiak AI. It's now trading on the NASDAQ under the symbol KDK. The deal values Kodiak AI at $2.5 billion, making it one of the most valuable de-SPAC deals of 2025 so far. Kodiak has received more than $212.5 million from its institutional investors. And joining us live from the NASDAQ is Kodiak AI CEO Don Burnett. Don, thanks for being with us.
Thanks for having me.
So you guys make a platform that can be applied to trucks to make them autonomous. Talk to me about the market for this so far and what you think the sort of potential is.
Absolutely. So the challenge in the trucking industry for several decades has been the shortage of drivers. And it's become clear that automation is the future of the transportation industry. And Kodiak's AI technology is powering those trucks and actually operating driverless in the hands of customers today. We operate both from a long haul perspective, and we also tackle the industrial market, which is more off-road applications of trucking.
And you guys, your customer, Atlas Energy Solutions, placed an order of 100 trucks. So you guys are relatively early stage here, but are there trucks on the road right now that you can see that are being run with your technology?
It is definitely early days. We've deployed now 8 driverless trucks to Atlas as a part of that order as of the end of August. And we're continuing to scale that production over time into Q4, Q1, and beyond. So it's certainly small days, but it's a huge leap for the industry, getting a driverless truck out there into the hands of the customers. Our trucks are owned and operated by the customer, and that's a big step forward. And so yes, it's definitely early times. We want to be slow and prudent with our rollout, but we think this is going to have a major impact on the industry.
And as I mentioned, and as you said, you delivered those 8 trucks. Do you have any other customers yet? Is Atlas Energy the only one? And what kind of discussions are you having with other potential customers?
We have trucks deployed with other customers, still with a safety driver behind the wheel. We work with some of the largest and most renowned trucking companies in the country, folks like Werner Enterprises and J.B. Hunt, amongst others. And we operate freight for those companies on a day in and day out basis. We have over a 23,000-mile commercial network across the southern United States that we operate on a daily basis.
Okay, Don, so I understand now that it's the distinction between driverless and like, it can be driverless, but you still, for regulatory reasons, I assume you have to have a driver in the driver's seat?
It's both for safety, R&D development, and regulatory issues combined. So it's all of those reasons we're working through, proving out our safety case to ensure that the trucks are fully safe before we actually pull the driver. So in certain domains for certain customers, we've already done that. We have nobody in the cab, and that's a really important step for any autonomous company, because that's where you actually start to make the high revenues and ultimately bring down your cost of goods sold.
Well, I'm glad you brought that up, the cost of goods sold, because I am curious about the cost curve, right? Because yes, you have a supply issue in terms of the drivers that are available, right? And that has been a challenge for quite some time. But I'm also curious about how much you pay a driver versus how much you pay for your product to make it autonomous, and when your product might be more cost competitive with an actual person, or where are we on that curve?
We actually look to make our product cost competitive right out of the gate. We've been working on this for over 7.5 years. Our business model is to be asset light. So we provide driver as a service. Our customers own and operate their own vehicles, and we effectively bring the same service that a driver would. And so they compensate us as they would a driver. And so our customers are seeing not only direct cost savings right out of the gate, but also efficiency gains and reliability improvements as well.
Interesting. John, we've talked to Aurora, which is, I assume, your most sort of direct competitor. Can you tell me how the two companies are different, and is the market sort of big enough that this is going to be a huge business and there's enough to sort of go around, if you will?
Absolutely. We think this is a massive market. We do not believe this is a winner-take-all market. We're still in the first inning here in terms of number of trucks deployed. You can almost count them on your fingers. And so it's very, very early days. We think this is a big market opportunity for Kodiak. We also have some distinguishing features. We play in the defense space in unstructured environments like our industrial applications for Atlas. And so Kodiak has some uniqueness in terms of the products that we offer into the market. We can serve additional customers beyond just the highway customers that others are focused on, but we also work with those highway customers, and we think that the market opportunity is sufficient for multiple players.
I'm also curious about the way you decided to come public, right? You came public through a de-SPAC, a special purpose acquisition company. This sort of was very popular a couple of years ago, waned in popularity. Now this year is coming back alongside IPOs. But why did you decide to go that route instead of a traditional IPO?
It's a factor of multiple considerations. So one of which, and probably most dominant, is the timing. A SPAC provides faster access to capital markets than a traditional IPO. When we went on this journey, we recognized that the public markets were a really exciting opportunity for the company, and we had heard from public investors that they were eager for multiple autonomy plays in the market. And the question was, when are the IPO market windows going to open? It was a little bit uncertain at the time, and we found a great partner in Ares, and we really felt like that was the vehicle to take us public.
That said, Don, finally I would ask, seeing some of the recent IPOs, straight up IPOs we've seen, they've seen pretty good demand, pretty good pop the first day. In this case, we're seeing a little bit of a slide in the shares as you guys complete this de-SPAC. Do you have any qualms about that action that we're seeing in the stock?
Absolutely not. It's the first day of trading, and we're really focused on developing our business, scaling our business. We're focused on the long term. We think that the market is a really attractive one. We think our technology is industry leading. And ultimately, as we prove out our business model, as we prove out our scale, we think that the markets will reflect that in value creation for our shareholders.
Well, Don, congrats on going public, and thanks for joining us.
Thanks for having me.
Coming up, we'll discuss the growing popularity of F1 with the CEO of McLaren Racing. That's next on Market Catalysts. Formula One is gaining popularity with viewership on track to hit a record for the 2025 season, an average of 1.4 million viewers per race. That's according to ESPN. The growth of the sport means it will likely garner a bigger price tag for its streaming rights next year. Apple offering Liberty Media $150 million per year for the rights, well above the $85 million that ESPN pays for the current package. That's according to reporting from Puck. Joining us now, Zach Brown, the CEO of McLaren Racing, and author of the new book, 7/10 of a Second. Also with us, Yahoo Finance senior autos reporter, Pras Subramanian. Thanks for being here, Zach.
Thanks for having me on.
Appreciate it. So the business of F1 has been really interesting over the past couple of years. Has gotten that extra boost from the Netflix series following it. You guys have also been winning, so that doesn't hurt matters. But as somebody who's been in this industry, like, what do you make of this trajectory over the past couple of years?
It's awesome. I think it's early days, which is really exciting. So if you look at when Liberty acquired the sport, the things that we needed to do to grow in kind of no particular order, but very important, was crack the code in North America. I think we've done that and are only getting started. We now have 3 races here, as you mentioned, new television rights, et cetera. The movie has been fantastic with Brad Pitt. Mm-hmm. Then we needed a younger audience, which we're bringing in. A lot of that is credit to Netflix, and more diversity in women from a fan base point of view. You put that all together with a budget cap, which has driven more competitiveness. Last year, 4 teams won races, 7 drivers won multiple races. That's kind of the first time in my 30 years of following the sport, seen that level of competitiveness. You have racing teams now lined up trying to get in the sport or writing checks. I know we're talking about value creation for $500 million just to have the right to be a Formula One team. Forget about what it costs to actually acquire a team, where not long ago a lot of teams were in trouble and you were buying them out of administration. We have 24 Grand Prix. We've got demand for about 30. So you put all that together and then put on top of that these great corporate partners that we have that are some of the biggest companies in the world that are also new to Formula One. The sport's on fire.
You mentioned some of those corporate partners, and back in 2008 there was teams that had cars with nothing on the car. Right now you have maybe too many sponsors.
No such thing.
So how do you? A lot of these sponsors are tech companies, big American tech companies. Why do you think the sport is appealing to them from your point of view?
I think especially in the tech space, where we use their tech, so there's great authentic storytelling. We've got the Googles and the MasterCards and the Ciscos and the Dells, who are all very integrated into our racing team. So I think that's become very attractive. The sport now also is very inclusive, where historically it had been very exclusive. And in today's world, where you need to engage with the fans, not just talk at them, but actually have a conversation with them. And I think Netflix was the start of opening that up. And it took a little bit of time for the sport to get used to it. When Netflix debuted Drive to Survive, 2 of the top teams didn't participate, which was kind of the old school thinking of, no, you can look, but you can't touch. The rest of us went, come on in and look at how the fans responded. And then that's brought in more sponsors. And so I think we're very relevant. And then we're also a pretty cool sport because there's a lot of different reasons why people follow the sport. Is it the drivers? Is it the teams? Is it global? Is it technology? Is it the drama on the track, off the track? So I think there's a lot of different aspects. So when I talk to fans, they all kind of have different reasons why they have fallen in love with Formula One.
You touched on it with the sort of the positive effects of the sport, the growing nature of the sport, and then that's going to lead to higher team values. And reports that McLaren Racing is selling off a stake at a pretty high premium. Do you see that as just the beginning? What can kind of keep that momentum growing? Because we're seeing that across all sports in general.
Yeah, I think I would say great value, not a premium.
By the way, do you want to confirm what the valuation of it is?
I'm not allowed to do that, but I've seen the various reports, and it's not a million miles off. It's been unbelievable value creation that McLaren's had, that the sport has had. I think it's a supply and demand. Coming back to a few years ago, 5 years ago, if you wanted a team, there was always 2 or 3 in trouble. Now you want a team, you have to write a check for $500 million just to get in. And there's only 11 teams now, where in other major sports, 30, 32, 28, whatever the number may be. So I think there's a scarcity. It's the largest annual global sport, so it's globally attractive as opposed to one specific market. And now with the cost cap in place, every team has a path to profitability and to competitiveness. So if you look at where we were losing significant hundreds of millions of dollars not long ago. Now we have record revenue, record profits, but most importantly, because we're a sports team, that's just a outcome of being good on track and being, having great partnership. We're winning races again, and that's because we're not getting outspent as we were before. So I think you put that all together, the sport's very competitive, globally very attractive, fiscally very responsible, and you put that all together, value creation.
Well, and that sounds like maybe an interesting investment opportunity for public market investors too, or something they might be attracted to. Is that in the works at some point to become public?
Not for necessarily for us, but I wouldn't be surprised to see teams do that. If you do look at the investors that have come in, historically they were a bit of who's that person, but now these are big PE firms, big investors, big countries. So you also see with the increased investment, the caliber of the investors that have come in are the big hitters around the world. And so it's exciting. I think the sport is now kind of caught up to where it should be when you look at the size and scale of Formula One compared to NFL, MLB, NBA, Premier League. We're as big, if not bigger, than the majority of those, and therefore I think all we've done is catch up to where the sport really should have been.
So you talk about running a team like a business, right? And in your book, you talk about you're a racer, but you're also an entrepreneur. You put together a lot of businesses, not just McLaren, and now McLaren is one of the top teams in the sport. What are some of the things you sort of learn as a racer, but also as someone running essentially a tech company that you talk about in the book, and you can kind of instill to young people, but also just sort of leaders in the space?
Yeah, I think, for me, and I think everyone's a little bit different, it was about surrounding myself with great people that were subject matter experts in their respective field. And then my job is I feel like I work for the team, they don't work for me. We have 1,400 people at McLaren Racing. I'm not designing racing cars, so I've got to kind of feed them, give them the technology they need, the people, the racing drivers, the sponsorship to be able to invest in the right tech. So I'm kind of an enabler, but they're the ones that are making it happen, and stability and culture are critical. So, our sport, the worst team in Formula One is really good. So the competition is immense. And so, I wake up every day, I kind of, there's two types of leaders in my experience. Those people that are motivated by the thrill of victory, those that are motivated by the fear of defeat. That's me. Probably the unhealthier, more stressful version, but I kind of wake up every day, and even though right now we're winning a lot of races, I'm worried about that inevitable day when we're not winning races. This is sport, that happens, and so that keeps me motivated every day and keeps the team motivated every day, that we want to stay on top of the mountain, because right now we're first and second in the drivers, we're leading the Constructors' Championship, so it doesn't get much taller. But you can look down the mountain, and we don't want to climb down.
I heard the loss of losing is 3 times worse than the gain from winning. So that's probably what we're talking about, right?
Yeah, 100%. Who likes to lose?
Zach, thanks so much for coming in.
Thanks for having me on.
Really appreciate it. Prost, thanks so much.
Thank you.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and the NASDAQ is leading all 3 major indices lower. If you take a look at the YF Interactive, we now are leading towards our 3rd straight day of losses. That's after 3 days of record highs. We see the Dow down about 0.2%. The NASDAQ just slightly leading lower compared to the S&P 500, down about 0.5%. And the S&P 500 also leading lower as well. And as if you could see over the past 5 days, this momentum that existed on Monday when the market had hit another record high. We even got calls from Goldman Sachs that they could see 6,800 for their price target for the S&P 500 at year end. We're now seeing this downward momentum. And we know that September is typically a weaker, a more volatile month. And on the last few days, we could be leading towards losses month over over the past month, we have seen the S&P 500 increase about 3%. And so we need to see some pretty significant losses over the next few days for that tail of time to continue. But if you do take a look, we did get some stronger than expected GDP growth revisions this morning, with GDP here in the U.S. growing about 3.8%. We also got lower than expected jobless claims, and we do see yields moving higher based upon that. The 10-year T-note yield up about 4 basis points. We also have the 30-year T-bond yields moving up about 1 basis point. And right now the markets are really pricing in that there's less of a likelihood that the Fed will cut rates in October. December rate cut projections down about 10% compared to just yesterday. And we can see the U.S. dollar rising on that implication, up about 0.5% today. And we are seeing the NASDAQ mostly in the red, led lower by Tesla, which is still holding on to the momentum. Year to date, it's now up about 5.6%. And just earlier this month, we saw it reverse the losses that it took year to date. In addition to that, we also do have a few others that are leading the downward momentum, like Strategy, that down nearly 6.5% today. But Nvidia, Apple trying to hold on to some momentum here. But once again, taking a step back, mostly seeing red, leading to what will be the third straight day of losses. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the session.
Now time for some of today's trending tickers. We are watching Tesla, Opendoor, and Accenture. First up, we got Tesla. Those shares are slumping as European car sales continue to plunge. Joining us for more Yahoo Finance's Allie Canal. So this has obviously been an issue for Tesla for a while, and there doesn't seem to be much relief.
Not much relief. If we take a look at the data, sales in the EU tumbled 36.6% in August. That means Tesla's market share in Europe is now 1.2%. That's down from 2% last year. So just continuing to see these sharp declines. And year to date, Tesla's EU sales are off 43%. And then if you compare that to China's BYD, which saw a 200+% surge in August sales, there really just seems to be no competition here for these Chinese EV makers. Tesla has been losing ground to some of these rivals for quite some time and really hasn't benefited from the revamped Model Y either. Shares are down today. You're seeing off about 4%, though they have rallied a bit over the past month after Elon Musk pledged to buy $1 billion worth of Tesla stock. But for Tesla, Europe just hasn't been the strong suit. In the US, it is pretty much the only option out there. Of course, you have the big three pushing deeper into the EV.
There's a lot of other options
but in the first mover advantage, I guess I should say, Tesla has been able to benefit from that and be the leader, at least in EVs. Yes. And overall, for EV adoption in the US, it's not quite at the levels that we thought we would be, especially with the rollback of the EV tax credits and then the infrastructure struggles as well.
Yeah, it's pretty amazing what you mentioned about the Model Y, because Tesla defenders, in the sort of depths of the PR crisis for Tesla, they were saying, well, it's just because it's not actually because of political headlines, it's because people are waiting for the Model Y revamp.
And now that's not translating.
Yes, exactly. I'm going to be really curious to see, once we start to lap the losses this year, then what next year's numbers for Tesla look like.
Yeah, and for the Tesla bulls out there, they're very focused on robotics. They are into the robotaxi rollout. But cars, EVs, it still makes up the bulk of the profits for this company. So they need to be able to deliver there, both in the US and Europe.
Right, definitely. All right, let's also talk about Opendoor. Those shares are popping. Jane Street revealing a $61 million stake in Opendoor. So those shares are up by about 5% today.
Yeah, nearly a 6% stake from Jane Street. And look, this is stock that some on Wall Street, like Eric Jackson, a hedge fund manager, is trying to make the claim that it's not a meme stock, but it certainly operates like one. Year to date, we're up over 400%. Opendoor shares also saw a nice pop after U.S. new home sales surged over 20% in August. This was the strongest monthly gain in over 3 years. So Opendoor trying to revolutionize the real estate industry, utilize AI. So any recovery that we can see there for the buying buying of homes, some activity that's going to be reflected, you would think, in shares here. But again, it does very much operate like a meme stock.
Yes.
It is very volatile, and we're continuing to see those up and down movements depending on certain headlines.
Right, exactly. Or on nothing at all sometimes.
Or nothing at all.
All right.
Yes, as meme stocks tend to do.
Yeah, exactly. All right, let's talk about Accenture as well. That company out with earnings that show how government cutbacks are affecting the consulting firm. Accenture, like many large consultancies, is pretty reliant on the federal government. And so they sort of quantified the effect that that's having.
Yeah, the cutbacks, we saw the Doge layoffs continuing, and in September, there was a lot of the expiration of some of those benefits. So I'm curious to see how that's reflected in the jobs numbers that we'll be getting shortly. But this is that multinational professional services firm, specializes in IT and management consulting. They reported $17.6 billion in revenue last quarter, topping estimates, but did say that those U.S. federal spending cuts could trim as much as 1.5% off of growth next year. Still, the company expects revenue growth between 3 to 6% and plans to return more than $9 billion to shareholders. And the CEO also saying that they're betting big on AI to train the entire workforce on new AI tools. You are seeing shares slip just slightly here, down a little bit over 1%. Over the past year, they're down around 30%. So a big struggle there. And I think you're hearing a lot from the companies that are struggling right now that they're going to be leaning in further to AI and hoping that the reliance on AI, or at least integrating that more into their business models, can reverse some of the declines or some of the slumps that we've been seeing. But execution, I think, is going to be key for investors, and monetization too. How is AI actually helping your company improve and perform better?
Well, and in the case of Accenture, their value proposition is they're going to help clients to do that AI integration. So it's not just helping internally, that's part of the services that they're pitching.
Right? Yes.
Exactly. So we'll see how that continues.
And you'd have to think that there is a big need here to train folks on AI and how to kind of get a new skill set in this current workforce. We've seen younger workers especially really struggle right now with AI as a factor there. So it's definitely important. It's just which companies can rise to the occasion.
Yes, and capitalize on it.
Yes.
Thanks so much, Allie. Appreciate it. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, coming up, we got much more markets action. Stay tuned. You're watching Market Catalysts.
Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves to your portfolio. I'm here now with Bill Davis, Tennessee Sustainable ETF Manager. Bill, let's start with what you like. And what you like is McDonald's. I was there yesterday, Bill, with the 6-year-old. Nuggets, fries, slushy was delicious, Bill. Here's what's not delicious, though. This stock is only up around 5% this year. You say it's an opportunity, though, Bill. So let's go through the reasons. 1, years of increasing dividends.
Yeah, actually 48 of them in a row. So we think it's a very strong value play. I think this is the time for a stock like McDonald's, this kind of market environment.
How come, Bill? What do you mean by that?
I think that there's all kinds of pressure on family income right now. I think actually there's a research company called Lightspeed. Turns out 44% of adults right now in America that shop fast food restaurants, the adults are buying off of the kids' menu. So I'm curious whether you did that when you were with your 6-year-old.
You know, you need one meal, and I always end up eating all of it anyway, Bill. Here's another second one. Here's the second reason you say revenue growth.
Yeah, I think that I think McDonald's is doing a lot of smart things around repositioning their pricing and their offerings, and is going to lead to revenue growth. In the last quarter, I think the revenue growth was 11%, or excuse me, it was 5%, and led to an 11% increase in EPS. But I think the things that they're going to do ultimately are going to make it harder for the competitors to keep up with them. And that's simply because of their scale. And think about their brand. Their brand is known as a value brand.
Sure.
And so I think it's going to be harder for competitors to match their pricing. And I think that the benefits are going to accrue to them, and it's going to lead to still more growth.
Final reason you say move into McDonald's, strong brand push on value.
Yeah, let me actually back up and just say that this STNC is part of the Hennessy family of funds. And it's basically 3.6 billion of assets spread across 17 funds, all very focused on high conviction portfolios. The difference with STNC is that in addition to looking at fundamentals, we're also looking at other attributes such as their material risk factors around ESG, and they happen to be a strong brand, largely relative to their scale, free of controversies. They're doing a lot of the right things. They're in the top half of their industry group, and I think that they kind of own the value story, and right now they're putting a lot of marketing dollars into it, and I think they're going to benefit from it.
So Bill, you made a convincing case why McDonald's is a buy. Before viewers, though, rush in, let's talk about the risks, potential erosion to margins.
Yeah, well, if you drive your prices down in hopes that you weaken competitors and basically scoop up the business, and competitors and the economy gets stronger, the job market gets stronger, inflation goes down. If all of those things happen, then it could turn out to be a bad play, because ultimately then you've eroded your margins and basically you haven't grown your revenues as a result. So that's the downside, but I don't really see that. I think that's a very low likelihood in the upcoming cycle.
All right, so you like McDonald's. Let's turn to one you don't like so much. You would avoid Darden restaurants. Now this one basically is gone nowhere year to date. Most analysts, Bill, on the street were paid to give an opinion. They like this one. You don't. So let's go through the reasons. One, concerns over revenue, EPS.
Well, Josh, let me start by saying I do like the company. We've owned them frequently in the portfolio. They're a good ESG story. They're a well-run company, and more often than not, we own them. I just don't think, for the same reason that I think McDonald's has a higher likelihood of generating strong revenue growth in the future, our revenue growth forecasts for Darden are sort of the opposite of that. We think they're going to have a harder time keeping up with revenue growth in this environment.
Second reason, you say this is one to avoid for now, challenging environment, you point out.
Yeah, I mean, I think that there's a lot of food cost inflation. I think Darden is going to get hit hard with beef inflation and seafood to a lesser extent. So I think it's more of a, Darden products are the places you go when you're feeling better about things. McDonald's are the places you go when you've got little kids who are hungry, or you're feeling, a little less secure about your financial situation.
Final reason, Bill, you think this one is one to avoid margin pressures?
Yeah, I mean, I think that Darden, by the way, is doing a lot of the same things that McDonald's is doing. It's trying to reposition its menu portfolio and related issues, but I think that that's going to put pressure for all of the other reasons I mentioned, the food cost inflation. I think it's simply going to put pressure on margin.
So Bill, this is one to avoid. What are sort of the risks to that call, though? Upside risks?
Well, I think it's the inversion of McDonald's, right? If the economy ends up being stronger than it appears to be, if the job market gets better, if inflation goes down, and then people start spending discretionary, funds at restaurants like Darden's, then I think their strategy pays off.
All right, so bottom line, you buy McDonald's, you avoid Darden. Bill, great to see you. Thank you for your time, those picks.
Thanks, Josh.
Appreciate it.
Small caps are finally having their moment, but investors still don't believe it. The Russell 2000 just punched through a 4-year bear market range to fresh all-time highs, but ETF flows are still negative on the year. And in today's Stocks in Translation, we're going to take a look at what it might take for small caps to finally soar once again. Now here's a quick lay of the land. The Russell 2000 index tracks about 2,000 smaller U.S. stocks, and basic minimums apply. They need a market cap of about $30 million, and the stock price has to be at least $1. The index is restructured with new members each June, and this so-called rebalancing is one of the highest volume days of the year. And finally, profitability is optional here, which is different from the S&P 600 that also tracks small cap stocks. That difference will matter as rates fall and money gets cheaper. Now let's take a look at the sector weights. Unlike its large cap cousins like the S&P 500 and the NASDAQ 100, the biggest sector in the Russell 2000 is industrials at nearly 20%, followed closely behind by financials with lots of regional banks. Then you get healthcare companies from biotech to services, followed by consumer discretionary, piling a bunch of retail names. And while tech is the biggest sector in the big leagues, it's only 12% of the Russell, in 5th place. The Russell 2000 is just a different animal than the S&P 500. It's more domestic, more interest rate sensitive, and more tied to credit or borrowing conditions. So in theory, the Russell 2000 should diversify a portfolio filled with mega caps, but you definitely want to make sure the setup is bullish. So let's take a look at a long-term chart. This here is the big picture price action view going all the way back to 2007 in the wake of the global financial crisis. That's when the Russell 2000 bottomed in 2009 and trended up through most of the teens, which you can see in green. Then we had a bout of sideways action in blue with a nasty shakeout in the early pandemic. But stimmies, GameStop euphoria, and a global everything rally rocketed this index to new highs into late 2021. And that would be the start of a new 4-year sideways bear market that we have in orange, that we're only now starting to climb out of. You're going to see a prior attempt to break out failed in late 2024. Now, from here, we want to see if that ceiling turns into a floor or support. Time to talk money flows. Here we're using the work of Todd Sohn at Strategas ETF Research, tracking annual ETF flows of IWN and other small cap ETFs in billions of dollars since 2010. What really stands out is that 2025 is negative so far. We've already had $10 billion of outflows, and the only other year with negative flows was 2011, and that was also a negative year for performance. So despite the positive 8% return this year in the Russell, investors just don't believe this rally yet. And if new money flows don't follow the price breakout that we just had, odds favor a dip into the old trading range, what we call a false breakout. Now let's lay out the catalyst that could drive small caps higher. First, we want to see if the technicals behave. Ideally, we'd see a further rally from here, and that old price ceiling of the 4-year bear market at around 2450, that should then become support. Then we'd want to see cooperation in the form of a weaker dollar and lower interest rates from short to long term. As the Fed is now cutting rates again, this helps lower borrowing costs and it loosens financial conditions. Lower rates are oil for the economy's squeaky wheels. Then we'd like to see those ETF flows pick up again. Are investors committing actual money to small caps? That right there would be the fuel. And finally, with earnings season once again around the corner, we're going to watch out for strong earnings and guidance, especially from small banks, industrials, and healthcare services. That's the roadmap. But only price pays, as they say. So watch out for higher highs, higher lows, the charts confirming the new uptrend. And tune into Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Upwardly mobile and ambitious professionals may become wealthy, but in many cases, they're too time-pressed to manage that wealth and chart a smart financial journey for themselves and their families. Citi's Global Wealth at Work program aims to bridge that gap, working with busy professionals early and throughout their careers at companies like law firms, professional services, asset managers, and pre- and post-IPO companies. With me on set is Kristen Bitterly, Citi Head of Citi Global Wealth at Work. Kristen, it's great to see you.
Great to see you too.
So I think this is a really interesting conversation to have, especially at a time when you have such a growing class of wealthy in this country.
Of course, yeah.
In part because we've seen in the markets, in part because of the explosion of the tech industry and people making money from that, et cetera. But it must be sort of overwhelming in some cases.
It is,
to manage through that. So what kind of mistakes do people make? What kinds of things do you sort of try to address with them?
So I think the thing that's most important is that everyone we work with, whether it's across law firms, professional services, asset managers, pre-IPO, post-IPO companies, they're really busy professionals. So they're trying to take care of their careers, they're trying to take care of their families, and there's honestly not enough hours in the day sometimes to focus on your own financial wellness and your own financial plan. So I would say, the number one thing is just having a financial plan. So 1 out of 3 Americans has actually completed a financial plan. Another fun stat is 1 out of 3 Americans has a will in place. So some of these basics going around, what are my goals? How am I going to achieve them? Am I set for retirement? What will happen in case I pass away, my spouse passes away? Those are things that we really try to hit on very, very early on. But I think the number one thing is we don't teach this in school. So financial literacy is something that impacts everyone. You can graduate from some of the best universities out there, and you may have all of your money in a savings account because you haven't been taught to invest. And so we find that we're able to get in there early, and drive better financial outcomes for our clients.
I'm also curious, though, at a time where, as I mentioned, part of what's been driving wealth creation and growth in this country is investment in the stock market, right? Many people who are invested, we've had a big up year again, right?
Yeah.
And so I wonder if some people become over-indexed to that, and what the outlook for the market is, and what the outlook for what that rebalancing should look like.
I think risk aversion is a really primary driving force. So what we tend to see is people underallocated.
Interesting.
To the market, to alternatives, for example. When it comes to certain vehicles like 401ks or retirement accounts, I think generally you tend to see within the professional space that people know that they should be doing that they should be allocating. There's a tax benefit there, and they're very comfortable letting that capital sit. Ironically, that tends to be the best performing capital, because it's something that is invested in the market. You are benefiting from that experience, and you're also not trying to market time that capital. And so more often than not, we come across someone who, yes, they have their retirement account set up, but then they have a huge chunk of their assets sitting in cash. And in this environment, yes, that may be okay given where interest rates are, but if we're going to be living longer and we need our money working for us harder and we want to retire at a reasonable age, it means that you are going to need exposure to not only just equity markets, but you're going to need exposure to alternatives as well.
Well, and so there are also implications not just for your clients, but for the markets more broadly, because you know as well as I do the cash on the sideline sort of
the
cliche
$7.3 trillion that is only increasing.
But now it actually feels like there is actually cash on the
Yeah.
sidelines, because people have gone on to cash into cash because it finally was yielding something. How much of that do you think then is going to come back into the market and also be supportive for equity prices?
So whenever we've seen a market pullback, as you know this year, people have been buying the dip. So you do see that activity, that if there's an opportunity, if there's an earnings miss, if we see a slight pullback, people will go in and buy the dip. I think we have to be a little bit careful about that cash kind of really in a material way coming into the market and being put to work. I think we have to wait till interest rates come down a little bit more for people to say, okay, this is a reasonable alternative. But I think when you just point to the equity market performance and what's driving it, we're in this tug of war between what looks like some deteriorating labor market conditions, what also looks like we saw the revisions to GDP where the economy is actually doing pretty well. And then, a lot of people are of the belief that we're just in the early stages of AI, and not just the primary drivers of that, but that CapEx spending that's going to come into other areas and drive productivity in other parts of the market. So there are plenty of reasons to think that this could continue in terms of grinding higher. And most importantly, it's just having a plan. So you don't want your psychology to drive when you're in and out of the market. You want to know, what is my time horizon? Can I withstand some of the volatility? And am I allocated and positioned in a way that makes me feel comfortable?
Do you guys, does the team there at Citi see stocks continuing to move higher from here?
I think if we're thinking very short term, very, very short term, everyone's pointing to just the seasonality and what happens at the end of September, and the last 2 weeks of this month tend to be the worst 2 weeks of the year. That being said, if you have a dovish Fed, if earnings continue to deliver and you're seeing, we'll see, we're right around the corner from Q3 earnings. If you see a kind of continuation of beat and raise, then I think you will see this market continue to grind higher. I think when you look at our portfolios though, they're very well diversified. So we do have allocations to fixed income where we're managing an intermediate duration of about 5 years. We have diversification when it comes to equities with a bias to quality and US exposure. So if you're looking at our portfolios, we're fully invested, but very diversified.
All right, Kristen, thanks so much for coming in. It's great to see you. Appreciate it. And that's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. We got more Yahoo Finance coming up.